Now let's start Chapter 9, a discussion about risks and returns. In Chapter 7 and Chapter 8, we have talked about bonds, bond valuation, stocks, and stock valuation. Now to understand the returns and risks in investing in financial securities such as bonds and stocks, we need to know how to measure the returns, how to measure the risks, and what is the relationship generally between the risks and returns in investments. So after this lecture, we will be able to calculate the return in terms of the so-called dollar return and also the percentage return. And then based on the historical returns, we'll try to measure and evaluate the risk of investment. There are several methods to help us measure and evaluate the risks, so we'll talk about them. And then we'll discuss the relationship between the risk and returns and how our understanding about the risk and return relationship can guide us in investments. And then we'll talk about diversification and how diversification helps us to reduce the risk of our investments. At the end of this chapter, we'll also learn how to calculate the return for a portfolio. So we'll start to think about return based on historical data. That's the idea of the so-called historical return. The historical return is about the past performance of a financial security such as a stock or an index. So if we look at an individual stock such as Amazon's stock or an index such as the S&P 500 index, we can look at the performance of the stock or the index in the past year or in the past 5 years, and we can understand the historical return for the stock or for the index. Now, why do we need to understand the historical returns, or why do we care about it? Because the historical return, or say the past return data, can actually help us to get some idea about what could happen in the future and predict the future returns. Of course, history may not repeat in the future, and we can't assume that the future will be just like what happened in the past. But nevertheless, some understanding about what happened in the past may help us get a pretty good idea about what could happen in the future. We'll start with the so-called dollar return, or say, look at the return based on how many dollars that we have made from investments. So we are looking at the so-called capital gain or loss, which is how much is the value of this investment at the end of the period, minus how much was the value of the same investment at the beginning of the period. So if you are looking at, for example, Amazon stock, let's just say if a year ago you bought Amazon stock at $1,500 per share, and today it was about $2,000. So the beginning value is the $1,500 that you bought Amazon stock at, and the ending value is today's price, which is the $2,000. So if you bought it before and you want to sell it today, you can make a $500 profit per share. That would be what we call as capital gain. And of course, if you bought the stock at a higher price, higher than the price today, then potentially you could make a loss, and that would be called the capital loss. If you buy and hold a stock and the stock pays dividends, then the dividend, how much dividend you can receive, that would be the income. So in terms of the dollar return from investments, we are looking at how much profit or capital gain we can make from buying it at one price and selling it later at a different price. And also we are looking at how much dividend or interest income you can receive during this period. So both capital gain or loss and the income are included in this calculation of the dollar return. So the amount of dollar return can give you a pretty good idea about how much money you can make out of this investment. However, the problem with the dollar return is when you look at different investment opportunities and you only look at the dollar return, sometimes it doesn't help you to make a reasonable comparison or make a reasonable decision on which investment opportunity could be better. So here, if you are looking at two investment opportunities, we'll just call it A and B. A is about investing $1,000 and make a profit of $100. And B is about investing $10,000, which is much more investment, and also get $100 back. So the dollar return is the same between A and B, same $100. Now if I ask you which one gives you higher return, if you only look at the dollar return, you can't decide because dollar amount wise, A and B give you the same amounts. But clearly between A and B here, A only takes $1,000 investment and B takes about $10,000 investment. So you may get the idea here that between A and B, maybe you would prefer A because it requires lower amounts of initial investments. So that's why we now look at another measure, which is the percentage or percent return. Now, percent return actually is based on the dollar return. So if you look at the top here in this equation, ending value minus beginning value plus income, this is the dollar return. But to calculate the percentage return, you just go one more step by dividing the dollar return by the amount of the beginning value, or say how much you have to invest at the beginning. And then you convert it to a percentage number. So this is actually a process of standardizing the returns from a dollar amount to a percentage number. And now when you do that, you can actually compare the percentage return across different investment and maybe make more reasonable investment decisions. If you think about the percentage return of the opportunity A and opportunity B that we just talked about in the last slides. So for opportunity A, the percentage return will be $100 out of 1,000. That will be 10%. And for opportunity B, that will be the $100 return divided by $10,000 initial investment, or say the beginning value, and that would be 1%. And now between A and B, which one is better? It's pretty clear, right? Now let's just do a practice question to calculate the historical return, both the dollar return and the percentage return. If we are looking at a stock that was about 103.33 per share at the beginning, and by the end of the year, it will be 106.69. So between 106.69 and 103.39, that's a $3.30 profit, or say capital gain. Income-wise, the company paid 35 cents per share dividend, so investors would receive 35 cents per share as dividend income. If you own 300 shares, then how much will be the total dollar return and how much will be the percent return? Dollar return wise, if we are looking at 300 shares, each share started with 103.39 and ended with 106.69. So we are talking about this much total as the capital gain, and 35 cents per share as dividend. So 300 shares altogether, it will be this much as total dividend income. If you add up the capital gain and dividend income together for 300 shares, that will be $1,095. and that is the total dollar return from 300 shares. And that's also about $3.65 per share. And out of the $3.65, 35 cents is from the income, dividend income, and then the other $3.30 is from the capital gain. When you calculate the percentage return, it doesn't matter actually if we are looking at 1 share or 300 shares. Either way, you should get the same result of 3.53%, which is based on the dollar return. Here you have for all 300 shares. So 1095 is for 300 shares. Accordingly, the investment would be 300 shares multiplied by 103.39 per share beginning value. So percentage return wise will be 3.53%. You can also try just for 1 share. So to calculate the percentage return, you would do $3.65 return per share divided by the beginning value would be 103.39 per share. You will get the same 3.53%. That is the percentage return. So imagine we can look at different period of time and calculate the dollar return and percentage return for one stock over 1 year, 2 years, or even 10 years. And then we can actually look at the average returns. Of course, people have done a lot of research on the historical returns of different securities such as bonds and stocks. And the general conclusion is based on the historical data, when we look at the historical returns, stocks generally deliver a higher return than bonds or cash if we look at the average returns across different period of time. However, we also need to be aware of the fact that we can't just look at the average returns to judge the performance of different investment because of the volatilities. So if we look at this table here, this is according to the historical data. People have calculated the return from the stock market, also from the long-term treasury bonds, and from the T-bills. If you remember from chapter 7, T-bills are very short-term treasury securities, and they have very high liquidity, and also because they are backed by the U.S. federal government, they are considered pretty much risk-free. So a lot of times we just look at T-bill return and consider that as the return from cash. So if you look at the historical returns, you get the idea that generally stocks have delivered higher return than the long-term treasury bonds, in turn delivered higher return than the short-term T-bills. However, sometimes the result shows different pattern. For example, in the 1960s, long-term treasury bonds return is very low, and also between 2000 and 2009, stocks overall delivered a very low return, and bonds actually did pretty good. So you got the idea that overall, again, stocks return look higher, but if we look at different year, stock returns can experience more up and downs and are considered more volatile. That also tells us, in addition to look at the average return across different time, different years, we also need to understand the volatilities in the returns. To compute the volatility, we use the standard deviation. You may have learned from your business statistics class that standard deviation is commonly used to measure volatility. Generally, the higher standard deviation, the higher volatility, or say the higher risk of investment. That's what you saw from the stocks. Standard deviation measures overall how much the return of an investment each period deviate from the average return. If we look at all different years, for example, the past 10 years, and we calculate the average return for the investment across the past 10 years, and then we look at each year, how the return every year deviate from the average. What we will do is to calculate a square term of this deviation and sum them up across all 10 years and then divide it by 10 minus 1. That will give us something called the variance. You may remember that from your stats class. So standard deviation actually is the square root of the variance. We'll use this example to illustrate the calculation of the standard deviation. Here we have the past 5 monthly returns. 5 numbers here, or what we would call in statistics 5 observation here. Each observation is a past monthly return data point. So when we have these 5 different numbers, first question is, what is the average monthly return across the past 5 months? That actually would be simple. If we want to calculate the average, we just need to add up the 5 numbers divided by 5. That would give us the average return. Now, you need to use the result of your average return to calculate the standard deviation, because remember, standard deviation is really about how every month the actual return deviate from the average. So if we are looking at the standard deviation calculation, you see that every month, for example, the first month will be 4.11%. So we use the 4.11% minus the average, and this average number is the result from the average return calculation here. For the second month, you do the same thing. You use the second month's return minus the average, just to see how the second month's return actually is different from the average return. So sometimes that monthly return is higher than the average, and sometimes, like in the third month, the monthly return is lower than the average. Either way, every month you calculate how that month's return is different from the average, and for each difference you want to square them, because if you don't, you add up all these 5 numbers, you get 0, and then you sum them up across all 5 months, and then you divide it by 5 minus 1, the m minus 1 according to the equation, and then you get the square root of it, and that is calculating the standard deviation according to the formula. So the standard deviation result here should be the 4.81%. Here I have another practice question just for you to practice and calculate the average return and standard deviation of the returns. In this question, we have the data from the past 5 years, and the return every year is given like these. And so the first thing to do is to calculate the average return, where you just add up the 5 numbers and divide it by 5, and you would get 12%. And then every month, for example, the first month, you will use 50% minus the 12%. That would be 38%. Then you use 38% square, and you go on to get the square term for the second month and third month for all the 5 months, and sum them up, divided by 4, which is 5 minus 1, get the square root of it. You should get the standard deviation of 37.68%. And of course, people have already done the calculation for the standard deviation of different investments. Overall, from 1950 to 2015, we look at the annual returns, and then we calculate the standard deviation of the returns in the past say 65 years, the standard deviation for stock investment, or say for investing in the stock market, is about 17.3%, which is much higher than the standard deviation of the returns from the long-term treasury bond investments. And if you look at the T-bill, standard deviation is very low. It's only 3%, much lower than the standard deviation from the stocks or from the long-term treasury bonds. And if you look at the different sub-period, for example, in the 1950s or the 70s, the pattern is very similar. Stocks generally deliver higher return, but the risks, or say the volatilities, are also much higher. The only exception according to the historical data is about in the 1980s or between 2010 and 2015. Well, there was pretty high volatility in the bond markets. So again, these are just what people have observed from the actual market in the past. And looking at the past data help us to understand that the general performance or behavior of the stock market or the bond market. Now that you understand the idea of the returns and the average return and the standard deviation of returns, we say with any investment, there is a risk and return trade-off. Generally, the investment that can deliver a higher return, they usually come with a higher risk. And the ones that come with very low risk, such as the T-bills, they deliver very low return. However, this relationship may not be totally linear. That's why we are looking at the so-called coefficient of variation. That helps us to understand relatively how much risk there is relative to the return from that investment. So the coefficient of variation essentially is the risk per unit of return. For example, if the average return from a stock is about 10%, while the standard deviation is about 15%, then the investors have to bear about 1.5 times of the return as the standard deviation, or say the risk. So that's the idea of the coefficient of variation. There are two questions from the end of chapter 9 that can help us understand this idea of risk and also the coefficient of variance. You have 3 different stocks here. This one has 12% average return and a standard deviation of 25%. And then the second stock has a return, average return of 15% and a standard deviation of 35%. The last one, 9% average return, 20% standard deviation. The first question is rank the 3 stocks by their level of total risk. And if you are to rank the stocks by their level of total risk, this is actually just to compare the stocks according to their standard deviation. Apparently, this one has the highest level of total risk, and this one has the lowest level of standard deviation, or say the total risk. But then, if you are asked to rank these stocks by their risk-return relationship, that's when you try to calculate the coefficient of variation. The first one, 12% return with a 25% standard deviation, so the coefficient of variation is about 2.08. Next one, 9% return, 20% standard deviation, so the coefficient of variation is 2.22. The last one has about 2.33. So now, if we try to rank them from the lowest to the highest, this is the 3 stocks ranked according to the level of coefficient of variation. And you see the order here is a little bit different from the results you have here. when you try to rank them just by the standard deviation, or say by the level of the total risk from those stocks.